Bitcoin's code has this built-in countdown clock. And right now, it's ticking towards a huge event set for 2028, the halving. So today, we're going to break down exactly what that means. We'll get into why it's basically the engine driving Bitcoin's value and how it's literally programmed to shape the future of crypto. So, what is Bitcoin's most important programmed event? What's the one thing that's truly hard-coded into its DNA? It's not some fancy software update or a new feature. Nope. It's this predictable, scheduled shock to its supply. It's called the halving, and honestly, it's the absolute key to understanding why Bitcoin is scarce.
So, let's get right into it. What is the Bitcoin halving? I know, the name sounds a little technical, but the idea behind it is actually super simple. And if you ask me, it's pretty brilliant.
Okay, here's the easiest way to think about it. Imagine a faucet for new Bitcoin. Right now, every 10 minutes or so, the miners who keep the network secure get a reward, a certain amount of brand new Bitcoin. Well, the halving is this pre-programmed event that just automatically turns that faucet down by half. It permanently cuts the flow of new coins coming into the world.
And here's the thing. This doesn't just happen randomly. It's not a surprise. It happens like clockwork, predictable as a Swiss watch, roughly every 4 years. Or to be super precise, every 210,000 blocks. This automatic timing is what makes it so powerful. There are no humans involved, no committees making decisions. It just happens.
Okay, but how does slowing down a digital faucet actually create value? That's the big question, right? Well, to get that, we've got to look at the numbers. That's where you can really see the mechanics of scarcity at work.
And the impact here is, wow, it's pretty staggering. Just look at this. Back in early 2024, miners were getting 6.25 Bitcoin for every new block. Then, boom, the halving hit, and that reward was instantly cut to 3.125. Now let's fast forward to 2028. It's going to get cut in half again, down to just 1.5625 Bitcoin. See the pattern? The supply of new coins isn't just getting smaller, it's shrinking at a faster and faster rate.
This relentless, totally programmed reduction is exactly what makes Bitcoin scarce. It's why people call it digital gold. It's the perfect analogy, really. Think about it. There's only so much gold we can pull out of the ground, right? Well, in the same way, there's a mathematically limited and increasingly rare supply of new Bitcoin.
Okay, so we've established the supply is shrinking. We get that. But how does that actually affect the price? Well, it all comes down to the most basic rule of economics, supply and demand.
It's really a powerful three-step dance. Step 1, the halving cuts the supply of new Bitcoin coming onto the market. Step 2, the demand, from investors and people using it usually stays the same or even grows. And step 3, well, what happens when less of something is available but more people want it? You get this incredible upward pressure on the price. It's classic economics.
And you have to understand, this isn't some weird market fluke or a bug in the system. No, this is the core feature. It's literally built into Bitcoin's DNA to get more scarce over time. It's like a monetary policy that's been etched in stone. It can't be changed by politicians or what's happening in the economy.
All right, so let's zoom out for a second. Let's see how this whole built-in scarcity thing makes Bitcoin so different from the regular money we use every day.
Here it is, the magic number, 21 million. That's it. There will only ever be 21 million Bitcoin created. Ever. End of story. And the halving, that's just the clever mechanism that makes sure we get to that final number slowly, predictably, and in a totally controlled way over many, many years.
When you put them side by side, you really see two completely different worlds. On one hand, you've got Bitcoin, fixed supply, predictable schedule, no central bank that can just decide to print more. Then, on the other hand, you have traditional currencies, basically an unlimited supply, controlled by central banks, and designed to lose value over time through inflation.
And look, this isn't just some theory we're talking about. We've seen this play out before. Historically, every halving has set off this cascade of events, and it's been remarkably consistent. First, you get higher long-term prices because of that supply shock. That price action catches the eye of big institutional investors. Then that makes mining more competitive, so miners invest in better gear. And all of that competition, it actually makes the entire network stronger and more secure for all of us.
All right, let's bring it all back to what's coming next. Now that we understand the mechanics and the history, what should we be looking out for as the 2028 halving gets closer?
Here's the most important thing to remember. In 2028, the flow of new Bitcoin is going to slow down again. This will make it mathematically more scarce than it has ever been in its entire history. That digital faucet we talked about, it's about to get turned down another permanent notch.
And if there's one number I want you to take away for 2028, it's this one, 1.5625. That's it. That's how many new Bitcoin will be created every 10 minutes. It's just a tiny, tiny fraction of what it used to be, and it's setting the stage for a potentially huge shift in that supply and demand balance. Which, of course, brings us to the biggest question of all. We get the theory, we get the mechanics, but what has actually happened to the price after the previous halvings? Well, in our next explainer, we're going to dive deep into the history books and look at the data. Can the past give us clues about the future? You are definitely not going to want to miss that.
Subscribe and visit Web3 Newswire for visibility and credibility of your Web3 projects.